Hello, everyone. Welcome back. Today, we're going to have a financial discussion about real estate and the value of homes. Okay. So, for those of you that don't know, my background is accounting. Okay. So, before I became a gun instructor, I was an accountant for many years. My last job was a chief financial officer for an import export company. Okay. So, I'm going to share with you guys an idea, right? A philosophy that I came up with back in the 1990s. I'm probably not the only one that had this philosophy with regards to real estate, but I came up with it on my own, right? And that is that the value of a property or a home or a building, whatever you're looking at, it doesn't matter whether it is, um, whether it's residential or commercial, the value of that property is equal to the value of the land that it sits on, okay, the value of the building materials, okay, and the value of the labor to basically build it. Okay, so three things: the the land, the building materials, and the labor. Now, if this is an income producing property, right? So if this is, let's say, a property that you would be renting out or would be generating some income, then I would basically factor in the revenue that I would expect it to generate over, let's say, a period of, I would average about 7 years. Okay, so within 7 to 10 years, okay, uh, I would want to fully recover whatever money I put into this property now. And I know if you talk to real estate agents, they'll tell you 15 years, 20 years, 30 years. You know what? That's not how I made money in my life, right? My way of making money, all right, is the way I created enough money to be able to do all the things that I do today, is any money that if I invested, I wanted to basically fully make back my money. Ideally within 5 years, but I was willing to accept 7, maybe 10 years, okay, to recover my money. And then after that, everything after that's gravy, right? That's just money coming in, and then all I have to do is just basically maintain the property. Okay, so that's not me following the book. Okay, that's me basically making up my own rules to make sure that I am successful. Okay, so that's my thoughts on investing in a business. You want to make whatever money you invest into it. Ideally, you want to make your money back within 5 years or sooner. Maybe 7 years. 10 years is like extreme as far as I'm concerned. But anyway, going back to what I wanted to talk to you guys about, when it comes to when you're looking at buying a home, those are the three things that I consider, right? If it's going to be a non-income producing property, meaning you're just going to live in it, you're not going to be renting it out or using it to generate, or working out of it or anything. The value of the land, the value of the building materials, and the value of the labor. Okay, so whatever it would cost to recreate that, okay, is what I consider the value of that property. Okay, uh, now from that point, right, from the point that it would be built, the property does not appreciate in value; it depreciates in value. Okay, now the land itself may not depreciate, but the building itself is going to depreciate. Okay, every year, it's going to start getting, the wood's going to start rotting. Basically that has to factor in. So when people look at a property or look at buying a property with the intention of they're gonna buy it and then down the road it's gonna appreciate in value. I mean, for me, that is that's a bad investment approach. Okay, the chances that you're going to fail, right, that you're not going to be successful, is, in my opinion, is a lot more than you are going to be successful. Now, you might stop and say, "Hey, wait a second. What are you talking about? Property values and home values have been going up for the last whatever 100 years or whatever." But the thing to understand is it's not the value of the home that has been going up. What's been happening is the value of your money has been going down. Okay, so it's not that the property has been appreciating; it's that your money has been depreciating, and basically it seems like the value of your home has gone up. Okay, but when you look, let's say I got a shovel from the year 1900, right? That moves 5 pounds of dirt. Okay, and then I got a shovel from the year 2022 that moves 5 pounds of dirt. Okay, so one shovel from 1900, one shovel from 2022, right, or whatever year. Okay, the value of both of those shovels is they move 5 pounds of dirt. It's not that maybe I paid 25 cents in the year 1900 and I'm paying whatever $20 in 2022. Okay, the value of the shovel has stayed the same. The only thing that has changed is that the money has depreciated. Okay, so when you're looking at real estate, that's the way I recommend everybody looks at it. Look at it in terms of what's the value of the land, what's the value of the building materials that went into it, what's the value of the labor that went into it. Okay, so the other thing I'm going to put out here for you guys is I want you guys to consider that when people look at the at the value, or rather the sales price, right? Because again, we're not talking about the value of the property, but the depreciation of the money, which we see as an increase in the price. Okay, the only people that benefit from the increase of the price of a property, okay, is the tax collectors. Okay, they're the only people that benefit. All right, so a lot of times I'll hear people say, "Hey, my house has basically doubled in value." Okay, number one, you're still living in it, right? So even though what's really happened is the value of your money has if it's doubled in value, what's really happened is that the dollar has lost half its value. But even for the person that's looking at it from the perspective of, hey, it's doubled in value, okay, you're living in it, right? The fact that it's doubled in value does not benefit you in any way. The only person that benefits from that is the tax collector, who basically is going to, because your property tax is going to go up. Okay, and it's different, from area to area. In some places they assess it every 10 years, but the bottom line is if it appears that the value of your house has gone up, sooner or later the tax collectors are going to want to tax you on that. Okay, so you don't benefit from living in that house that you think has doubled in value. Okay, now if you go to sell the house, right, because you got to sell the house now to get that money, well, you got to go live in another house, right? So again, what are you going to do? You're going to sell this house, you got double your money. Well, now you're going to go live in. The only way you're going to somehow get money out of this is if you go live in another house that's like half the size, right, or half the value of that house. So if you move from, let's say, to a cheaper house, right? So the point is that makes no sense. Okay, you don't benefit from a price appreciation in the value of the house that you're living in, right? Because you gotta, in order for you to actually get to actually see that money, you have to sell it, and then what are you gonna do? You gotta take that money and now you gotta go buy another house, right? So the money's gonna go straight into that one. The only thing that might happen now in all of that is now you gotta pay a tax on the capital gain. So the thing with capital gains on a house, if you have a capital gain, you pay a tax on that. The only person that's benefiting from that is the government. Okay, now are exceptions in the tax law where if you sell a house and then you immediately buy another house, the basis kind of rolls over into the other house so that you don't pay it. So anyway, that's all tax BS. We don't need to get too deep into that. But the point that I want you guys to understand is that that you don't benefit from an increase in the property in what appears to be an increase in the property value. Now, the other thing I want you guys to understand is part of the reason why the value of houses sometimes seems to increase is because of bank lending. Okay, so here's the thing: consider it like this: if banks stop lending money, okay, everybody has to buy the house with whatever money they have saved up, and that's it. And don't think it can't be done. I've done it twice. Okay. I don't pay interest to banks. Okay, I do not pay interest to banks. Okay, this property over here, paid cash for it. I do not pay interest to banks. Okay, that's a good way for when you're in your 20s. That's what you should be planning for. Okay, you should be planning for down the road you're going to buy a house. You saved up that money so that you can buy that house without having to pay the price 3 times over to the bank, right? Because if you buy a house for, let's say, $500,000, by the time you're done paying it back, you're going to give the bank $1.5 million, right? So you're going to pay 3 times over. So the thing to understand with banks, if when banks are lending out money, what they are really doing is they are artificially inflating the value of these houses. And what do I mean by that? So again, if you had to buy the house just for cash, just the money that you have, in your savings account, right? You're going to be very conscious about what you're paying for that house. Okay. However, if you've got a bank that's willing to lend you money, right, and then also willing to lend the other guy and the other guy and the other guy, right? So now you've got everybody over here bidding up the price of these properties with money that they don't have, right? So basically, the casino, right, which is the bank, is lending you money so you can gamble, basically. Okay, that's what's really happening here. So the banks are lending money to everybody. Everybody feels that they have all this extra money. So on a house that, let's say, the value of it is only, let's say, whatever, $100,000, because everybody's getting money from the banks to, everybody's bidding up the price. So now, even though the price of the land, the price of the materials, the labor costs might only total up to $100,000, because everybody's coming to the table with money that the bank is lending to them. Now they're willing to bid up the price to $200,000 and $300,000 on a house that's only worth, let's say, $100,000. Okay, so the banks artificially inflate the value of these homes just by being willing to lend out money to everyone. Okay, and we saw that back in 2008. Why the real estate prices go so high? Because the banks were just basically just throwing money at people, and people were like, hey, why shouldn't I be willing to offer more, to make a higher bid, right? I got the bank backing me up here, okay? And also they're thinking in the back of their mind, hey, if I pay for this house that, let's say, is only worth $100,000, they're thinking, okay, so I'll pay $300,000 for it. But hey, in their mind, it's like real estate prices are going up. A couple of years down the road, I'll sell it for $500,000 or $1 million, right? So that's what people are thinking, right? And I'm telling you guys, the logically, looking at this logically, okay, the value of a home is worth the land, the building materials, and the labor to build it. Okay, that's what the home is worth. Now, that's what the home is worth. Now, if this is an income producing property, right, then basically I would evaluate the income that is likely to generate. Okay, so again, a quick, easy way to figure out, this is a number I would add to it. If I want to fully recover my money, let's say within 5 years. All right, so whatever money I expect that this will generate over the next 5 years, right? So let's say it's just random number. Let's say it's going to generate $10,000 per year. Okay, when I want to fully recover, so that's $50,000 over 5 years. So I would take that $50,000 and I would add it to the value of the land, the building materials, and the labor. Okay, so so those three things plus that $50,000. And that's the price I would put out for this. Okay, so my thoughts on this. I hope if you guys got different ideas, by all means, put it in the comment section. But again, when you're looking at real estate appreciating in value, it's not the value of the property that's going up; it's the value of your dollars going down. Okay, thanks for watching. I'll talk to you all soon.